the things that confronts you when you build your equity investment portfolio is how much returns to expect, right? So with individual stocks, you possibly do your research and you're able to kind of fix a certain target price, the potential of the stock or the fair value as you call it. But when it comes to an entire portfolio, either of equity mutual funds especially, or even a portfolio of stocks, so you need to have an idea about how much your portfolio will return, simply because your own goals are aligned to that returns. You need to know how much to save to attain your goal, and for that purpose the single number called returns becomes very important for you. But what happens in reality is that we don't know how to kind of identify what this return should be. So we pick an arbitrary number because we are told that equity markets in general deliver double-digit returns. So it could be a 15 to 20% return because people generally, like that number, because there have been many times in the past when the markets are supposed to have delivered those kind of returns over the long term. So people arbitrarily put a number to it. But what happens when you base your, kind of a goal on these numbers, right? So let me just quickly take you to this slide here. So let's suppose that you're doing a monthly investment in, say, equity funds of 10,000, and you know that in 5 years you want rupees 10 lakh, right? So you do this math with a simple future value function at 12%, and then you realize you are getting only 8.2 lakhs, not the 10 lakhs that you believed you would. You tweak it to 15%, and then you see it's not my 8.96 lakhs or so. And then you decide, okay, I'm going to take more risk because I need this 10 lakhs. So let me put 20% in this rate. And when you put 20%, you get this 10 lakhs. And this 10 lakhs, because this 10,000, with 10,000 getting 10 lakhs is possible only with a 20% return over 5 years. You decide that is your return expectation. Right? Now, the thing is, that is your requirement, but that's not what market may deliver. It may deliver, it may not deliver, right? So this is the fundamental issue that we all have when we do a simple Excel calculation of our return expectation. Now let's try and understand whether we could base our return expectation on something else. First, let's just understand how these past returns, I'm just taking 5 years because in most of our minds, equity is about at least 5-year investment. So this is 5-year rolling return. Rolling return is nothing but returns today over 5 years ago and so on, picked at right through at various points in time. You will see that the market indeed has delivered 15% returns, but it has also delivered negative returns in the past, right? If you see March 2020, for the period between 2015 to 20, it has even delivered negative returns for 5 years. And there have been many instances of single digit returns. In fact, of over 1,000 instances, there are probably only about 300 and odd instances of returns being over 15%, which means that this arbitrary number of 15 to 20%, there is a very high probability that it will not transpire, right? So this is what happens when we base, our expectation either on past returns or on the arbitrary figure of 15-20%. Now let's see how we can kind of base it otherwise. Let's take some clues here from what is called as real returns that the RBI keeps talking about. So some years ago, the former Reserve Bank Governor Mr. Raghuram Rajan spoke that savers need to get some real returns over and above, the inflation. Real returns is nothing but the returns on your investment over and above inflation. Inflation is consumer price inflation. He said you should get at least 1.5 to 2 percentage points more than the inflation in a product like deposit, right? So that's adjusting for inflation so that you have some actual returns. Your return is not negative. There have been periods when FDs did not give even inflation rate, but that is their endeavor. So if he thinks a simple low risk product such as a bank FD has to give 1.5 to 2 percentage points more, right? You could possibly, kind of look at how inflation has been over this, several years. I have once again taken 5-year rolling and 3-year rolling. These are not year to year, year on year returns. I have taken longer periods based on the consumer price inflation index. We have looked at the various rolling returns, and you can see here that inflation has been in quite a bit of a range, especially the 5-year inflation. This base starts at 2012 2013 January, so please remember that is why the data here is first beginning for the 5-year at 2018, right? So you can see that it ranges anywhere between 5 to 6%. It has gone to periods of much higher inflation as well. I'm talking of 5-year. So on a year-on-year basis, we have had periods of 9% inflation and all that, but over a period of time. Now, if this is the return and your FDs return, say, something like 7% or so, on an average. So, like the former governor said, you do get about 1.5 percentage points more. So, in a simple product, fixed income product, if you're getting that, perhaps, in a more complex product like equity, you're expecting 3 to 4 percentage points more. It's a very, very kind of a fair ask given the risks involved in equity. Now you might wonder, come on, is this 3 to 4% not an arbitrary figure? It might seem arbitrary on the face of it, but let's look at it in a very different logical angle without getting into equity risk premium calculation and all that, which I'll come to in a while. Just look at it. A bank basically takes deposit from you, say at 7%, and lends it to a corporate, right? Mostly. I mean, they also lend it to you, but lends to a corporate at least 1.5 to 2 percentage margin. Let's suppose a company, say an infrastructure company, takes this money from the bank that you have given as deposit. The bank charges, at least 1.5 to 2. It could be much, much more because they're making profit out of it. And now when this corporate, say, borrows from this bank at, say, 9 or 10%, they should, this is their cost of capital. They should make return on their capital higher than this cost, right? So that has to be at least 11% or 12%, right? So on a very, very rough basis, we do know that banks have a margin, at least of 1.5 to, it has been shrinking over the years, but it's still there. So that's the case. And a company has to make profits on top of it. It has to get some return on the capital that it has deployed. It has to be higher than the cost of capital. So to that extent, this 3 to 4 is not entirely wrong, and it will tally well with the other numbers that I'm going to talk about. So that's the rough ask that we are talking of here. Right now, roughly, if an FD can give 1.5 to 2 percentage points, you could possibly add another 3 to 4 percentage points, both for the bank's margin and then the company's own ability to deliver higher than its cost of capital. So that's the point that we are. So you can then, kind of mentally fix where that number comes to. We'll come to it all again together to tie it up. The second thing, is called equity risk premium, right? Equity risk premium this is a different approach. We are taking a risk-free, instrument. A bank FD is not necessarily a risk-free instrument. It has some risk. A government bond, typically a GSEC, is a risk-free. For example, a 10-year GSEC today is at 7%, right? It's considered a risk-free rate. Now, typically lower lower period instruments are considered. But if we are looking at equity, we need to take a 5-year GSEC or a 10-year GSEC to look at equity, because equity is a long product. So the ability, to deliver over and above this risk-free rate, the premium at which equity will deliver over this risk-free rate is the equity risk premium. Why is it called a risk premium? Because you want higher returns for the risk that you're taking in equity. So to that extent, what is that higher return that you get over and above a risk-free rate? So a risk-free rate plus that ERP or equity risk premium is the asking rate that the equity market wants for investing in a risky asset class called equity. Now, RBI has done quite a bit of studies on this. Occasionally, we come out with papers. I have given the link here. they have identified that, this risk premium, ranges like we have seen here. It has been at 5%, it has gone even up to 8.5%, has come down. But look at when this risk premium is very high. When the market has very high risk aversion, it wants a much higher premium to invest in equities. Essentially, when the market is very down, there is severe risk aversion, and that is why you will see in 2008, you know, 2009, 8, and 9, there's this big spike. Nobody wants lower return in equity. The expectation of return is very high because the risk perception after the 2008 global crisis was very high. So, typically, when you decide you want returns out of your equity, at what point you're investing will matter. If you're investing at the lowest point, you can. I mean, now it ties up, right? It's very logical to expect very high returns when you're investing at the lowest point in equity, when nobody wants equity. That happened in 2008, that happened in 2020, as you can see. Look at the spike that, these RBI data shows here. You know, Post COVID, we had the shutdown, and we had a lot of credit crisis, debt crisis, and all that. But the equity market in March 2020 significantly fell also, right? So there is risk aversion, and when there is risk aversion, the premium that people expect, that the market expects out of equity, goes up, right? So that is how you base your expectation on, on this. Equity as an asset class. That is your expectation. I'm not giving a number here. If you want to do a number, you can look at these ranges, right? They range on an average between 5 to 6 percentage points. You can see that roughly, maybe 4.5, 5 also for certain periods if you take. It depends on what period. So if you've been at the worst, market where the risk premium is very high, from there on, you obviously your return expectation will be high. But this RBI data will give you a rough idea about what range to expect. But to keep it low or to keep it high would depend on the market condition. Worst market condition, you can expect high because prices are depressed. And you expect high because you don't want to enter unless the market gives you really good returns. When the market is at the end of a bull rally, everything is very smooth still, it's all going good, and your expectation has to be lower, right? It is also logical because you're at a bubble territory basically, and the risk premium, everybody is investing. There is no risk aversion. So when there's no risk aversion, this shrinks, right? So this chart here will basically tell you the range that you can expect over say a 10-year GSEC over a long term, and it will also tell you when to reduce your expectation, when to increase your expectation. Right, so let's go to another approach that we have here, and this is a very simple approach. This is simply based on nominal GDP growth. You would have heard many mutual fund managers say in the long term, your market returns will largely, kind of mirror the nominal GDP growth. But what is nominal GDP growth? We all know that GDP growth is being talked of at 7%, 6.5%, 6.2%, and all that. But what is nominal GDP? The GDP that is talked of is mostly real GDP. That is without considering the price rise, the inflation that happens, right? In nominal GDP, it is the market value of all the goods produced in the country overall, right? That means it takes into account, it is a price, current market price. So it takes into account inflation, etc. So real GDP plus inflation theoretically gives you the nominal GDP. And here we are looking at the growth of the nominal GDP in this data in 5-year buckets. Okay, look at the returns. 5-year ending March 2017, that means 2012 to 2017, 12%. 2013 to 2018, 11.4. 2014 to 19, 11, and so on. And look at Nifty's returns. Largely, it's very, very close to it. But remember, right, in a year like March 2020, the market hits rock bottom far before the economy does. You can see that Nifty 50 delivered just 1.6% returns for the 5 years ending March 20 because there was a significant correction in March 20. There is an anomaly here because, in a way, we are taken point to point returns, that is March 15 to March 20. But still, the market hit rock bottom and then the economy slowed later. You can see that in March 21 is when, the 5 year block ending March 21 is when it truly reflected. And by the time the market had already picked up. So in these turnaround years in the economy, a return expectation can go a bit of a toss. So when the economy is at a peak, basically you have to kind of reduce your return expectation because sometimes you can be in that block of years when things really go bad, right? But on an average, let me tell you, if you go by this, on an average, the GDP at nominal rate has grown by about 10.7%. The Nifty has grown by about 12.2%, right? Nifty 50. Naturally, if you add more risk to it, which comes in the form of mid caps, and I've taken Nifty 500 here to show, that mid caps have been added there. The returns is slightly higher in earlier periods, as you will see. But there are also periods when the returns have not been great because mid caps didn't do well. Be that as it may, the fact remains that if you're very unsure of how to base your returns, you could look at the past few years nominal GDP growth. You could Google, you'll be able to find those returns. And if you're already at a lower point, as in the nominal GDP has been falling down, we are kind of hitting the bottom, you can have slightly higher return expectation. So your nominal GDP plus something, 1 to 2 percentage points, like 7.5, you could say your return expectation is about 10, and we ended with 15, right? So uh, keep the nominal GDP growth as your return expectation in equity, and anything over and above that comes is bonus. Okay, that comes for the risk premium that one takes. And please remember, this is full GDP at market price. If I remove the agri part of it, the GDP growth will be slightly higher. It will be closer to the Nifty 50. So there's not much of a difference, right? It's probably to do with the quality of companies in Nifty 50. They have grown at a higher pace and therefore the returns are slightly higher. But largely, if I remove agri, it will actually reflect this. So you don't have to look, at ERP. You don't have to try and understand risk-free rate. You can actually base your return expectation on an average of the last, few years of GDP. But if you're at the bottom, like I said, you can slightly tweak your returns upward. And if you think, your nominal GDP is at double digits, like 11 and 12%, you need to take care about your return expectation because the next few years may or may not deliver in the same way, which is what we see. There is an uptick, there is a slowdown, and there is an uptick, which is what happened in March 22 is better than the March 21. Right? So this is how basically returns move. Again, it's not easy, but one of these approaches, the first approach is also easy. Please remember, I'm giving you an arbitrary figure, but you will see that it ties well, with these returns also, right? So if, for example, your FD gave 7%, like I said, on an average, I said add 3 to 4 percentage points roughly, and you will actually get the return expectation of around 11%, which is a very fair ask over this period. So this 15 to 20% return expectations, etc., do not always happen. They happen in some cohorts, yes. When the market is at a boom, not just the market, the economy, capex, everything has come together. Interest rate is conducive, inflation is reasonable, not too high or not too low. All of these will have to fall in place for that purpose. And those are outlier numbers. It would be better for you to keep it closer to what all that we saw. Everything, as you can see, I don't want to say I'm predicting any kind of return here, but everything falls around that 11 to 12%. If you see, look the averages. And please remember, the law of averages always catch up. So let's not forget that, right? So just to kind of, close this, instead of tweaking the 12% return to 15% or 20%, in case you realize that you are falling short, the only way out is to increase your savings. So instead of the 10,000 monthly investment that you started with, I just tweaked it to 12,500 and you're there on your goal, 10 lakh 31,000, right? So this is where most of us go wrong. So the return number is simple Excel trick, but it doesn't really help because it's not within your control. What is within your control is your savings rate, and the easiest and the most conclusive thing that you can do is to up your monthly investment to reach your goal. That's about it.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.